this is Attorney Andre. We all heard that a good, safe investment portfolio contains 60% stocks and 40% bonds. However, that setup is largely dead based on high inflation, that the Fed hiking interest rates at its quickest pace in decades and transitioning from quantitative easing to quantitative tightening. So although you have the S&P that has returned an impressive 20.46% over the last year, only seven mega cap tech stocks were responsible for that return. And those seven are Apple. I mean, you know what they are. They're Apple, they're Google, they're Facebook, they're Microsoft, they're Nvidia, Amazon, and Tesla. The other 493 stocks in the index are only up 7%. And then you have the year to date on the S&P, and that's at 4.32% at the time of filming this video. So look, based on the historical data, if you take a look at everything, you have a P/E ratio of 20.5, and the S&P returned an average annualized return with that P/E ratio of roughly 7%. But right now, you can find high yield savings accounts with 5% or more without any risk to the downside, because high yield savings account, you can't lose any money. While the Fed is unlikely to raise interest rates much higher, officials have also signaled that they're unlikely to cut rates anytime soon. I mean, we had the FOMC meeting, and it was very clear that the Fed is not going to cut rates anytime soon. And a lot of people are saying that they were expecting rates to be cut anyways, and they're pricing that into the market. But the reality is the Fed is not going to cut anytime soon. I think that they're saying what they mean and meaning what they say. And that's been the trend for everything. I mean, when have they said one thing and did something else the next day? I mean, I guess there are multiple examples of that. In any event, doesn't really matter. It's very clear the rates aren't coming down anytime soon, especially with real estate prices just starting to come down, especially with the economy just starting to cool off. But if you remember, around 2020, a little bit before COVID, you had a passive investor. Any passive investor in the market could earn roughly 16% per annual. And that's the data from the S&P 500, the data from the actual Standard & Poor's. And that data is usually annualized on a monthly total returns. But essentially, it doesn't matter what sector you invested in, because they all made money. Everything made money. Then, if you remember, around January to February of 2021, the S&P peaked, and then it just fell. It crashed and it fell, at some points getting down to minus 20% from its all-time highs. And if you had invested when all of that hype was around, if you had that fear of missing out and invested then, you would have just made back the majority of your money. Now, if you invested through a broker, that would have sucked, because you would have paid whatever their broker commission fee is, whatever their annualized fee is. That would have really sucked. But you would have paid that, and you probably still wouldn't have recouped all of your returns, despite the S&P hitting all-time highs. So while interest rates bottomed in 2020, last year really witnessed the steepest rise in interest rates, particularly real rates. And when I mean real rates, I mean nominal rates less inflation. That's what I mean by real rates. And that occurred with the 2-year yield spiked from negative 3% in March of 2022 to 3%, while the 10-year real yields rose from negative 1% to around 2% today. That means that U.S. Treasury bonds are now looking at a source of yield when that was not really been in play in the past. What's more, that 60-40 split only works when you have a situation like in the last decade where money was cheap and the Fed kept printing. So a 60-40 portfolio generated an 8% real returns. However, that same portfolio between 2000 and 2009 got you real returns of negative 3, meaning you would have effectively lost money adjusted for inflation. And if you're paying for stuff like broker fees, you're losing even more money. So essentially, you got guys like Warren Buffett. They say that you should just keep investing in the S&P index. You should keep diversified into all 500 different stocks. But you have other guys like Bob Rice. He's the chief investment strategist of Tangent Capital. And he spoke at the 5th Annual Investment News Conference for Alternative Investments, where he predicted that a 60-40 portfolio was only projected to grow at a rate of 2.2% per year in the future. And that if you really wish to become adequately diversified, you need to incorporate stuff like private equity and venture capital and hedge funds and commodities like timber and collectibles and precious metals. On that same line, you have BlackRock, which generally favored a private credit fund, and their private credit fund that has a real year return of roughly 10% year over year, That's been an alternative method of investment beyond the 60-40 split. You have Alex Shahidi, who is the co-chief investment officer at Evoke Advisors, and he published a paper for the IMCA Investment and Wealth Management magazine in 2012 that's still really active today. It's still really important to read it today, where he broke it down to 30% treasury bonds, 30% treasury inflation protected securities, 20% equities, and 20% commodities. And that situation is really great for high inflationary periods. So if you've got an actively managed fund, probably it makes sense to have those things moved or shifted around a little bit, because the 60-40 split as it is today is not really the best investment vehicle, as time will likely show. So if you're seeking alternative sources of similar returns to 60-40 portfolio with less risk, you have that high yield savings account. A lot of them are trading at around 5% or giving you a yield of around 5%. Now, yeah, that's less than 7%. Fine. 5% is less than 7%. But if you take in for the real money earned, which is minus the financial advisor taking his cut, minus all of the other fees and costs, you're really losing out on possibly less than 2%, if not that same 2%. So it seems it might be worth giving up that 2%, because really you're making more in the long term than just that 7%, which you're going to lose anyways on whatever these fees are. You have other classes of investments such as commodities, real estate, and cash, and all of that might be better than the 60-40 split, or it can be used in conjunction with the 60-40 split. But there are so many things you can do. But I got to tell you, the future, at least the way that I'm looking at it, is more like the 2000 to 2009 future than the 2010 to 2020 future. Or past, I guess to say. In any event, check it out. Like, comment, subscribe. What are you doing? Are you maintaining that 60-40 portfolio? Are you sticking with it no matter what? Or are you going to diversify a little bit into different classes, including cash? Cash is fantastic. They always say cash is king. I never met someone with a lot of cash that say, God, I wish I had less cash. I mean, I guess I can point to a couple of people that actually said that, but I don't think that's the right strategy. Because if you've got cash, then you've got something to deploy. Talk to you soon. Let me know what you think. Again, like, comment, subscribe. See you later.